Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're talking about FDIC limits and what you can do to shore up your cash and keep it safe if you have more than the $250,000 FDIC limit. So we talk about what the FDIC is, what the limits are, the nuances of account titling, and how you can arrange your accounts at one bank to be entitled to more than $250,000 limits by adjusting the titling on your accounts in the proper way, and when you might want to spread your cash out amongst multiple institutions. So we covered the current state of the banking situation after Silicon Valley Bank went under and First Republic Bank ran into all sorts of problems. And we get into the differences between banks and credit unions and when a credit union might be a reasonable option for you to keep your cash or perhaps to start a relationship with. So we talked about a lot in this episode. I think it's a good one if you're someone who's concerned about the state of your local bank, and I hope you enjoy listening to it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Today on the show, I would like to talk about the banking situation, particularly First Republic Bank and some of the smaller regional banks around the country, because they're coming under a lot of pressure. And on the day that I happen to be sitting here recording this, First Republic has seen its value per share on the open equity markets fall by about 50%. To zoom out here a little bit, it started the year, I was just looking at the chart, at about $150 per share. When the markets opened this morning, they opened at about $6 a share, and then they fell closer to $3 a share. And so we're in a banking environment where some lenders are running into problems. And this was, of course, originated from Silicon Valley Bank that went belly up here 4 or 6 weeks ago, something like that. And now First Republic Bank, which is kind of adjacent to Silicon Valley Bank in the marketplace, is running into trouble as well. So what I wanted to do on the show today is talk about this in a little bit more depth, talk about the situation that each of these banks is in, where the risks are, but more importantly, what we should do, what you should do if you're concerned about the viability of your bank. How should you be thinking about this with regard to the cash that you have, both maybe in your household and or in your business? So we'll cover FDIC coverage, the specifics of what's covered, what's not covered, what are the limits on different types of accounts, the difference between banks and credit unions, and maybe a few strategies you can use to protect your cash. So just to jog everyone's memory, this Silicon Valley Bank was a total cluster here, cluster being short for a more pointed word, here 4 or 6 weeks ago. And the background there is Silicon Valley Bank was a pretty large banking institution in Silicon Valley that worked with tech companies and entrepreneurs. And they ran into trouble because, as any bank does, they bring in cash from deposits and then they turn around and lend that cash out at a higher rate somewhere else in the marketplace, either to a business in maybe a small business loan, or for somebody to go buy a car or a mortgage in an auto or a home loan, or they go out into the open market and actually buy bonds. And Silicon Valley Bank had been working with venture-backed businesses who are younger on the age spectrum, newer businesses that had a lot of cash coming in from their venture capital investors. So these businesses all parked their cash at Silicon Valley Bank. And the reason that's relevant is that the balances per customer at Silicon Valley Bank were way, way higher than what we typically see at larger, more Main Street oriented institutions. So places like Wells Fargo, JP Morgan, Bank of America, none of which I'm a fan of for a couple of reasons. But nonetheless, the balance per customer at each of those institutions is a lot lower because they're working with everyday people like you and me that don't have as much cash, whereas Silicon Valley Bank is working with venture-backed businesses that have a ton of cash. And so the point of that is because of its customer base, Silicon Valley Bank has always been more susceptible to a bank run. They take in cash from all these businesses, they keep some of it on the balance sheets, and then they lend out the rest of it. And as long as they're able to earn more interest on their loans than what they have to pay out to depositors for putting their cash there, that margin is where Silicon Valley Bank makes its money. It's where any bank makes its money. Well, they had grown at an astronomical rate over the last few years. And forgive me if you've heard this before on maybe a few episodes again, because I did cover this story back then. But this is important, and that's why I want to rehash it here. They had taken in deposits at an unsustainable rate. That's mistake number one. They should not have grown as fast as they did, because when you grow as a bank at the rate that they did, you have to find somewhere to put the cash. You can't operate and just take in deposits without doing something on the other side of the bank's balance sheet and lending it to other parties for interest margin. Because if you don't, then you're going to have to pay the depositors, right? You have money coming in that you have to pay interest on. And if that cash is not reinvested, they're going to be unprofitable. They'll lose money. So they went out into the marketplace. They issued loans. They tried to offer lending facilities to the business customers that they had, but they exhausted all of those avenues. They don't want to lend money frivolously to non-credit-worthy customers. And so when the demand for loans goes away, when they've exhausted all of it, they still have cash coming in because they're growing at such a rapid rate. They have to do something else with it. And so they decided to purchase U.S. Treasury securities. And because of the way that works, it, just like any investor like you and me could do, the bank had to make a decision over, do I buy short-term U.S. government obligations, medium-term, or long-term U.S. government obligations? And they made the choice of purchasing longer-dated U.S. government bonds. So if you're an institution, there's nothing wrong with purchasing long-term U.S. government bonds on their own, but your assets and your liabilities should be matched. And what I mean by that is if you want to, let's say that you or I want to, we were just having this conversation in the office a few minutes ago. Let's say that you want to put a pool into the backyard, and that pool is going to cost $100,000. Well, if you want to put the pool in 3 years, one thing you could do is put a little bit less than $100,000 into a 3-year U.S. government bond. And between now and when that bond matures, you get a little bit of interest. You get $100,000 when the bond matures. And then you have your cash ready to deploy toward putting that pool in to pay the construction costs. What you probably don't want to do is go buy a 10-year bond, because it'll be 10 years before that thing matures. And when you need the cash in 3 years, you're going to have to sell the bond at whatever the market price is. And so a bank has this asset liability matching game that it's constantly playing. And ordinarily, deposits from its customers are somewhat stable. There are all these teams of analysts at big banks that look at deposit activity and want to make sure with a very, very large margin for error that they will not get out over their skis and have longer dated assets than liabilities. Because if everybody wants their money back all at once and you're stuck with 10-year bonds instead of 30-day bills or notes, you could be in a lot of trouble. And that's exactly what happened to Silicon Valley Bank. Is they took on cash too rapidly. They didn't have enough places to put it, so they bought U.S. government bonds. And rather than making a prudent decision and buying relatively short-term bonds, they tried to squeeze out a little bit extra yield and went too long out on the yield curve. They purchased, I don't know what the duration of their portfolio was, but longer than it should have been is the point. So they needed they needed to have cash available over the short term, and they ignored that warning and that issue and bought longer dated bonds. And so what happens was, as you and I know, inflation went up, the Federal Reserve raised interest rates, and that pushes the value of those bonds down. And the longer dated the bond, the more impacted the value of that bond is in the secondary market. And so Silicon Valley Bank had all this interest rate risk as a result of its portfolio decisions, which was a poor decision, to say it lightly. And then interest rates went up. The value of their portfolio went down. They didn't have to realize any of those losses unless they would be forced to sell the bonds. So they have a customer base that makes it susceptible to a run. They realize that they're in trouble. They have all this interest rate risk. Interest rates are going up. It's pushing down the value of their portfolio. They're trying to keep the thing afloat. They have a choice at some point of selling the bonds at a loss, realizing the loss to maintain liquidity and make sure they don't run into trouble. They choose not to do that and wait it out and hope that interest rates revert and that and they can recover from it. Well, that didn't happen. It went the other direction. Depositors caught wind of it. They pulled all their cash out, and there was a run on the bank. And so that's, in a nutshell, what happened with Silicon Valley Bank and the spiral. And so if you're a business that was banking with Silicon Valley Bank, that puts you at a whole lot of risk if you have more cash than what the FDIC covers. Now, cut to the chase, jump to the conclusion here. As Silicon Valley Bank was circling the drain, the FDIC came in and the feds came in and deemed it a systemically important institution. If they had let Silicon Valley Bank go under without making depositors whole, that would have had widespread implications throughout the banking system. And I feel like they made the right decision here and made everybody whole, not because I'm a fan of bailouts on their own, but because Silicon Valley Bank has its tentacles kind of throughout the entire economy, and the ripple effects would have been huge if they had allowed that thing to circle the drain and eventually go under without making depositors whole. So realistically, what this means is, if you have a business with some venture capital backing, maybe you have $1 million in cash that you're managing to make payroll and do all your other stuff in your business. Well, if you're banking with Silicon Valley Bank, the first $250,000 of that million is covered by FDIC insurance. Everything above that, or $750,000, is not covered by FDIC insurance. So if your bank goes belly up like Silicon Valley Bank, and you're in that situation, you would have lost $750,000 of cash. And the FDIC would have come in and put enough money into whatever was left from Silicon Valley Bank's corpse, basically, to allow you to withdraw $250,000, but no more. In this circumstance, they made everybody whole. So rather than losing out on $750,000 of cash, the feds covered the entire million, which, as I said, I think is a good thing. That being said, Since then, First Republic is now having some problems. People are pulling cash out of there in droves. If you're someone who's concerned about this, even if you're not concerned about this, you should absolutely not rely on the FDIC or the federal government to make you whole above that $250,000 mark going forward. The only reason that it happened was because they deemed it a systemically important financial institution. And if that terminology rings a bell a little bit, it may be because I've talked about it on the show in the past, or you may think back to the financial crisis when this happened a lot too. And the feds had to decide which institutions to prop up and save and which to allow to fail in order to maintain some semblance of economic normalcy. So Silicon Valley Bank, systemically important institution, despite all their faults and failures and poor decision making. And there is certainly a political problem with that, right? You have a situation where if you're an executive at Silicon Valley Bank, you're incentivized to take those kinds of risks because that's how your bonus. Taking those risks can lead to more profitability. Your compensation is tied to that profitability, so you make more, and you don't have as much of a risk if your institution, if you know that the government is going to come in and bail out all your depositors. So there's a moral hazard here for institutions in that in that space. So what do we do now? Right, there are some issues, pervasive issues, I think, in the banking system, particularly with these smaller regional banks. Silicon Valley Bank was particularly susceptible to this, but a lot of other banks around the country are in a similar situation. They've taken on cash over the last few years. They've loaned out that cash as much as they can, but they've had to supplement those loans with federal government debt obligations that are probably worth a little bit less in the secondary market today than they were maybe 2 years ago when they were purchased, because interest rates have gone up and suppressed the values of them. So as individual investors, like I've talked a lot about on the show, you can wait it out. If you own a 10-year bond and interest rates go up, you're still going to get your money back. You just have to wait 10 years for that to happen. A bank doesn't always have that luxury of just waiting it out, because it's borrowing money from people like you and me who put cash into a savings or checking account, and then it's using that to go buy the bond. So I have no doubt that other banks around the country have similar situations, but whether any of them are truly susceptible to problems depends on what the entirety of its portfolio looks like, how much those portfolio holdings have been marked to market, and how many of the losses have already been realized, and it depends on the depositor base too. Back to the Silicon Valley Bank example, you have far fewer depositors with much higher balances per account. Wells Fargo has far more depositors with much smaller balances per account. And one relevant stat, I'm going to bastardize this because I can't remember the exact numbers, but something I read here a couple weeks ago is that a very small percentage of, if you look at all the checking and savings account balances that Silicon Valley Bank had, only a small percentage of it was covered by FDIC insurance. And I want to say it was something like 6%, but I could be way off on that. It's been a month, and I can't remember what the exact portion was, but it was a small portion of the overall asset base, overall deposit base at Silicon Valley Bank. I don't know exactly what it is at JP Morgan or Wells Fargo, but at Charles Schwab's bank, and I looked into this because we custody client funds at Charles Schwab, and I've got an ongoing obligation as the supervisor of those funds to make sure that it's a viable institution. Something like 80 or 85% of Schwab Bank's cash is covered by the FDIC. So more customers, smaller balances, because remember what that threshold is, $250,000. So let's cover the rules here of what this FDIC insurance is, What are the thresholds? Can you have multiple accounts? What if you title them differently? All that stuff. So as we talked about, the limit is $250,000. Banks that participate in this, and I believe all banks are forced to. I don't think that there's a situation where you can put cash into a deposit account, like a checking or savings account, and have that at a place that doesn't participate in this program. I think in order to receive deposits like this, you absolutely have to participate in the program, that is. The bank pays a premium, like an insurance policy, to the FDIC to participate in this program. And again, it is forced to participate in this program. It's probably I would think that it's like a percentage of the deposits over some cycle, maybe a 12-month cycle. Average deposits month over month would make sense, but I don't know the exact details. You put cash into the institution. If the institution goes bankrupt, the FDIC is guaranteeing to make you whole up to $250,000. Now, there are ways to increase those limits. So if you have $300,000 in cash and you have deposited that cash at your local bank, if it sits in an account in your name, then only the first $250,000 will be covered. The remaining $50,000 will not be covered. If it's a joint account with you and your spouse, the limit is $250,000 per co-owner, or in this case, up to $500,000. So if you're in this situation and you have a whole bunch of household cash, you might think about how you're titling your accounts in order to, because at the end of the day, in this environment, we want to make absolutely sure that all your cash, or as much of it as we can possibly insure, is covered by the FDIC. Okay? Because again, other regional banks are going to have problems, and this could continue to spiral over the next 3 to 12 months. So it's $250,000 per owner. Now, if let's say you have an individual account and a joint account with your spouse, the limit is still, as I understand it, $250,000 per owner. So if let's say there are 3 accounts, you and your spouse both have an individual account and you have one joint account, you don't get $500,000 for the joint account and another $250,000 for each of your individual accounts. The total is $250,000 per owner across those accounts at that institution. If you have 3 accounts set up like that at Wells Fargo and another 3 accounts set up in the exact same way at JP Morgan Chase, it's per account owner per institution. So if you have $500,000 in cash, just like we're talking about, you could have half of it in an individual account at Wells Fargo, the other half at an individual account at JP Morgan, and be covered. Now, there is a convenient workaround here too. And I was just on the FDIC website clarifying my understanding of this a few minutes ago. But as it stands right now, if you have a trust, it doesn't matter whether it's revocable or irrevocable, and that's important, and I'll comment on that and comment on why in just a moment. The limit is $250,000 per trust or per beneficiary of the trust, up to 5. So this is pretty convenient, because if you're someone like my wife and I have a revocable family trust and we have 3 kids. So that means that if we have our bank account in the name of our trust, the FDIC limit would be $250,000 times 3, because there are 3 beneficiaries, or $750,000. If we had it in a joint account, which is what probably most people around the country would do in this situation, your limit is only $500,000. So it's another good reason to title. If if this is congruent with your estate planning strategy, if you're trying to avoid probate, you might have a revocable living trust. It's a good reason to put your bank assets in the name of the trust if you have more than 2 beneficiaries, because it increases the FDIC limits on that, which is really convenient. Now, I was under the impression before clarifying my understanding of that that was only true for irrevocable trusts, because revocable trusts, you can put assets in, you can take assets out, you can use assets while they're in the trust. Any tax ramifications pass back to you as the grantor of the trust. And so it's kind of it's a see-through kind of entity. I didn't think that would impact the FDIC limits, but that's not true. It does. And again, the limits in a revocable or irrevocable trust are $250,000 per beneficiary. Now, if you have a business account, it's $250,000 per entity. So if you have a corporation and a bank account in the name of the corporation, your FDIC limit is $250,000. If you have a business and it's split up into 2 or 3 different entities, one thing you might want to consider is having a bank account for each of those different entities, because that can theoretically increase the FDIC coverage on your cash if you have more than $250K sitting in the bank. So those are a few things to consider. How you title the accounts is important and relevant, and where you keep it is relevant. At the end of the day, we want to be safe with our cash, but we also want to command the best potential yield on that cash at the same time. And that's part of the reason I'm not a huge fan of JP Morgan Chase and Wells Fargo for these banking kind of relationships, because they're big institutions, which means that they're stable. They are definitely systemically important, and that's, adds some stability to the whole equation, but they pay you hardly anything on your cash. And there are far better interest rates available out there. Ally Bank, Capital One are both paying somewhere around maybe 3 3/4 or 4% per year on their high yield savings accounts. So that's far better. The other thing that you might want to think about here, well, just a moment, the reason that, we want to think about how we have our accounts titled, and then if you've titled everything in a way that maximizes your FDIC coverage, and you still have some cash at a bank that is uncovered by the $250,000 FDIC limit, that's when we want to think about spreading it between a couple different institutions. So if it were me, I like simplicity with my cash and with my banking stuff, with my personal finances. That's what I recommend to our clients when they're setting this stuff up. We have to really fight to keep things simple, because it's easy just to add accounts and have more moving parts and cash going from here to there, and it just gets overly complex really quickly. And we have to fight against that, because you will reach a better financial destination long term if you can be really clear about what you're trying to achieve, what your objectives are, and you keep the logistics simple and as automated as possible. If you have more cash than what is covered at the FDIC, then it's time to think about putting a portion of it with a different institution. Because again, in this environment, it's important to have that coverage. Now, another option here, I mentioned a couple of the big, huge mega banks. Another option is a local credit union. Local credit unions can be great deals. The difference between a bank and a credit union is that a bank is a for-profit institution. A credit union is not. It's a not-for-profit organization that's purpose for existing is to offer its members or customers the best possible terms on financial products. So if you're Bank of America or JP Morgan, you're going to try to pay as little as possible on customer deposits and charge as much as possible on loans, because the wider your spread between deposits and loans, the more money you make. And remember that this is a publicly traded corporation that's driven by long-term profitability. That's how all the executives get paid. The whole system is set up to maximize shareholder profits. With a credit union, that's not the gig. A credit union is overseen by a board of directors. There are no profits at all. So anything that is optimized for profit at a bank is the philosophy is completely different at a credit union. Oftentimes, credit unions are specific to a certain group, like a certain industry, or like around us, Schools First is a big one. It's a credit union for teachers. So sometimes you have to be a member of a certain group in order to open an account there. But the benefit is that you probably have lower fees in general. You probably have lower fees and lower rates on credit products. You probably have higher rates of return being paid on savings accounts. The downside is that usually credit unions are not reinvesting aggressively into infrastructure and technology. So the app on your phone might be a little bit clunky. You might not have quite as many local branches to walk into compared to Bank of America, which is on like every street corner in the country. And again, sometimes there are eligibility requirements for being a part of them. But I think it's kind of an overlooked possibility. I mentioned predominantly online lenders like Ally and Capital One. Those are great options as well. But it's kind of nice to have a relationship with a credit union, because if you need to go out and get an auto loan or something like that, having a relationship with them will qualify you to take out a loan if you need to for that kind of stuff. Additionally, and I should mention this because we're talking about the FDIC, credit unions are not covered by FDIC insurance. They're covered by NCUA insurance, National Credit Union Administration, which functionally is the exact same thing. The limits are the same. The limits per account, per ownership group, like we're talking about trusts and non-trusts and so forth, all that stuff is exactly the same as FDIC coverage. It's a different program that credit unions pay into to insure deposits. So that's the back to front of it. We might have some more issues in the banking system. Commercial real estate is something that a lot of people are concerned about. I was reading a little bit on that. The commercial real estate, the issue is that office buildings are vacant. They're falling in value. People want to work from home. After COVID, a lot of companies are allowing them to work from home as opposed to forcing them back into the office, and which means that they don't need as much office space as they once did. And banks are in the middle of this entanglement because some of their loans are against commercial properties. And so if you're the owner of a commercial building and you have a loan out against that building that you took out to purchase it, you have to make payments to the bank. And you make those payments because you've leased the building out to tenants, to businesses who pay you rent every month. Well, right now the money is coming in. But ordinarily, commercial real estate leases are for a minimum of 3 years, often 5, 7, 10. And over the next few years, those leases are going to expire and will need to be renewed or renegotiated. And so what we're hearing in the commercial real estate space is the value of office buildings is falling dramatically, and that will be realized over the next couple of years as these longer term leases start to come due, because the majority of them have not had to be renegotiated quite yet. There was an article the other day in the Wall Street Journal about an office building in downtown San Francisco that was purchased, I don't know how many years ago, but not too long ago, for about $300 million. And it's on the market for 60 now. And it's that kind of stuff that banks are going to have to deal with, because if you're the bank, you've taken some of your cash, you've given it to the purchaser to go buy the building, and then you're collecting that interest and principal back over time. But if those leases are renegotiated, there's not enough cash to pay back the loan. That's a problem for the bank. They're going to have to write down that debt. So there's some speculation that the bank portfolios, that the banking situation we're in now, could continue to spiral and get really bad. That's possible, and I do think that a lot of banks have longer term treasuries on their balance sheets, just like Silicon Valley Bank did. But I think that around the country, in most banks, the deposit base is a little more diverse, and the more depositors you have per dollar of deposits, the less likely it is that you're going to have a run against the bank, because it takes more people to for that to catch fire and gain momentum. And even though they have longer dated bonds on their in their portfolio, commercial real estate only comprises 1.5% of bank portfolios nationally. So as much as we like to jump to the conclusion that the commercial real estate is going to drag down the banking system, which is something that you can probably find articles on, the reality of it is it's a really small percentage of bank portfolios. It could be a problem, but if the banking system really runs into trouble, it's probably not going to be from commercial real estate. So that's it for today. I hope this was helpful. If you have cash in any bank that exceeds the FDIC limits, I think if I were in your shoes, number one, I would look at making sure the accounts are titled the right way as to maximize my FDIC coverage. Don't run out there and add beneficiaries to your trust for the sole purpose of adding FDIC insurance coverage. You want to make sure that that's done for the right reasons, because it's just as easy to open a second account at another bank and move some cash over there to where you're under the limits at both institutions. So those are a couple things to think about. But there is a little bit of gamesmanship that can be played with the titling at any one institution to maximize your coverage. We did not talk about SIPC today. Maybe I'll rant on that for just a moment. Everything we've talked about today is in a bank. It has nothing to do with investments in your brokerage accounts, mutual funds, stocks, bonds, ETFs, cash, even in your brokerage account. It has nothing to do with that. Brokerage firms pay into SIPC, the Securities Investors Protection Corporation, which is the brokerage affiliate of the FDIC, basically. Brokerage firms pay a little bit of a premium to participate. And if your brokerage firm goes under, like Silicon Valley Bank did, the SIPC will come in and replace the securities you had in your account up to $500,000, of which $250,000 of that can be in cash. If you're on margin, if you put $100,000 into the account and you borrow money from your brokerage firm and you use that $100,000 as collateral to buy $125,000 worth of stock, this is a legitimate risk if you're above the SIPC limits. If the brokerage firm goes under, you have to come up with that difference somewhere, right? And it's possible that you could lose some of your shares. If you're not on margin, you have nothing to worry about. You put $100,000 into the brokerage firm. You use that $100,000 to buy $100,000 worth of securities, and the brokerage firm purchases them on your behalf and puts them in your account. They're in street name, most likely, meaning that they're actually titled to Fidelity or Charles Schwab or whomever, but they are earmarked and set aside to remain in your account. So what happens if you have an account at Fidelity, you have $100,000 worth of stocks in there, and then Fidelity goes bankrupt? Well, they have the securities are already in your account, right? There's not been any loan extended to you to buy them. You put in $1 and you bought $1 worth of securities. They're already there. In a bank, you put the $100,000 in. The bank is going to keep some of that cash on its balance sheet, and then it's going to try to lend as much of it as it can out on the other side to make margin between the loan interest that they collect and the deposit interest that they have to pay you. That's not happening in your brokerage accounts unless you're on margin. If you're on margin, the stocks in your account are used as collateral, and the brokerage firm has the ability to lend them out to other institutions. And that's what security is, partially what securities lending is, which is where I started my career and spent a lot of time. So they're totally apples and oranges. I think our primary concern as investors probably should be with our banking cash. If you have more than $500,000 in securities and are on margin at any institution, a lot of brokerage firms will cover insurance above and beyond that $500,000 from larger outfits like Lloyd's of London and so forth. But there are aggregate limits on those policies, and if Fidelity goes bankrupt, it's very unlikely that that those insurance policies are going to be large enough to make every single depositor or every single account holder that has over $500,000 whole. So just a couple things to think about. You probably want to look into it if you're on margin and have more than $500,000 at an institution. If everything is fully paid for, there's really very little to worry about, I think. Okay, that's it for today. Hope this was helpful, and we'll talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.